Singapore's inflation surge. A cause for concern or a temporary blip? Singapore's core inflation rate has reached a new high for 2025, sparking discussions about its economic implications. Official data revealed a significant jump to 1.2% year-on-year in October, up from 0.4% in September. This figure is particularly notable as core inflation had lingered below 1% for months, with the last time it surpassed this threshold being December 2024 at 1.7%. But what's driving this sudden increase? The answer lies in a combination of factors. Firstly, services, food, and retail prices have been on the rise. Secondly, the decline in electricity and gas prices has slowed down, contributing to the overall inflationary trend. And this is the part that might surprise you. The monthly core prices grew by 0.5% in October, indicating a steady upward trajectory. The inflation story doesn't end there. Overall inflation, measured by the Consumer Price Index all items (CPI all items), also accelerated to 1.2% in October from 0.7% in September. Private transport prices played a significant role in this increase. However, when excluding non-consumption expenditures like housing and financial asset purchases, overall inflation remained unchanged on a monthly basis in October. Now let's break down the sectoral contributions. Services inflation skyrocketed to 1.8% in October, compared to 0.3% in September, due to rising health insurance and healthcare costs, as well as holiday expenses. Electricity and gas inflation, while still falling, did so at a slower rate due to stabilizing electricity prices. Food inflation also inched up to 1.2%, with non-cooked food prices leading the charge. Retail and other goods inflation saw a minor increase to 0.4%, influenced by pricier clothing, footwear, and personal effects. Here's where it gets controversial. Private transport inflation rose to 3.8%, driven by soaring car prices, while accommodation inflation dipped slightly to 0.3% due to moderating rental increases. But are these trends here to stay? MAS and MTI, the financial and trade authorities, predict that Singapore's imported costs will continue to decrease, but at a slower pace. They foresee global crude oil prices declining more gradually in 2026 compared to 2025, with regional inflation showing a modest recovery. However, they also caution that the inflation outlook is uncertain, as supply shocks, especially those linked to geopolitical events, could unexpectedly push up imported costs. And this is the part most people miss. The authorities suggest that a sharper decline in global demand could keep core inflation suppressed for an extended period. Conversely, a substantial drop in global oil prices could temporarily slow down the overall price growth. So, is this inflationary trend a cause for concern or a temporary blip? The answer may lie in the upcoming month's data. What do you think? Share your thoughts, and let's discuss the potential economic implications for Singapore.